Hello everyone. I will start chapter 5 in this lecture. This chapter is about modern portfolio concepts. These are some of the topics that we will cover in this chapter. So we start with an understanding of portfolio. So what is a portfolio? It is a collection of investments to meet certain goals. By investments, I mean different assets. So it can be a growth-oriented portfolio. So the idea is to ensure long-term price appreciation. Price at purchase increases significantly, which leads to high returns for the investor. The other is income-oriented portfolio. So in this case, the portfolio will produce regular dividend payments or interest payments. So what is portfolio objective? The portfolio objective is to create an efficient portfolio. Efficient portfolio provides the highest return for a given risk level. So to do that, we look at some examples. So we combine different investments in same asset or in different asset classes. The portfolio return is the weighted average of individual investments. So the individual weight corresponds to the percentage share of each investment in the portfolio. So we have the example of stocks of Walmart and Century Casino. So the portfolio has 80% share of Walmart and 20% share of Century Casino. So based on this weightage, we find the portfolio returns. The next approach is to find the risk associated with the portfolio. So for that, we find the standard deviation of portfolio return. So we can find the standard deviation of each stock. So we use a similar formula for the portfolio. We have already found the portfolio return. We have the average portfolio return for the period in consideration. So that helps us to find the standard deviation for the portfolio returns. So we can do it mathematically, or we can also use Excel formulas. So the standard deviation of a portfolio depends on three factors. The first is the standard deviation of each asset in that portfolio, the percentage share of each asset in the portfolio, as well as the correlation between any two assets in the portfolio. So what is correlation? Correlation is a statistical measure. So it gives us an idea of the relationship between two variables. Positively correlated means the two variables move in same direction. Negatively correlated means the two variables move in opposite directions. And uncorrelated means there is no relationship between the two variables. So if there is perfect positive correlation, that is, if one increases, the other also increases in the same direction, then the correlation coefficient is +1. It is perfect negative correlation. That is, if one increases, the other decreases, the correlation coefficient is -1. So we try to find the correlation of returns for the two stocks in this portfolio. If it is positively perfect positive correlation, both will move in the same direction. And if it is perfect negative correlation, the returns will move in perfectly opposite direction. So when one portfolio is at it, one stock is at its highest return, the other will be at its lowest return. Similarly, in perfect positive correlation, whenever one stock gives the highest return, the other stock will also give its highest return. So how is correlation related to portfolio diversification? So if the correlation is +1, that is perfect positive correlation, then the portfolio risk is the average of the individual risk of the assets. If the correlation is less than 1, then the portfolio risk is less than the average risk of the assets. So what we see is if it is less than perfect positive correlation, the standard deviation of the portfolio decreases. When the correlation is -1, that is perfect negative correlation, then we can find some combination, some weightage of individual assets which will lead to zero risk. So this is the benefit of portfolio. So we can find a combination of assets which have perfectly negative correlation, and we can combine them in certain percentage which leads to zero risk. So if we look here, there are two stocks, Consolidated Edison and Duke Energy. They have very high positive correlation. So their portfolio also has similar trends in terms of return. We look at another portfolio. So one is Pro Shares ETF and the other is Vanguard S&P 500 ETF. These two ETFs have strong negative correlation. So if we look at the return, it is generally stable. They cancel out each other. So this is the formula for portfolio risk. So we have the weight of each asset, the standard deviation of each asset, and we also have the correlation between the assets. So that helps us to find the portfolio risk. So again, we go back to the example of Walmart and Century Casinos. So we have found the portfolio deviation for different portfolios. The different portfolios have different contribution of Walmart and Century Casinos. So what we notice is that the correlation is negative between Walmart and Century Casino stock. So based on that correlation, we are able to find the standard deviation of different portfolios formed by combining these two stocks. So this example is a 50-50 combination of the two stocks. So now we move on to this graph. So this is a graphical plot of portfolio return versus portfolio standard deviation. So we start with a portfolio having only Walmart stock, that is 100% Walmart. We gradually increase the share of Century Casinos, and we notice that the portfolio return increases, but the standard deviation decreases. That is, the return increases, the risk decreases. This risk reduction and return increase happens till one point, that is 80% Walmart and 20% Century's Casino. Beyond that, if we increase the contribution of Century Casino stock, the portfolio return increases, but the risk also increases. So the most optimal portfolio is 80% Walmart and 20% Century Casino. This is the portfolio which will give the maximum returns for the minimum risk. We have another set of portfolios, the assets X, Y, Z, and we create two portfolios. One is with asset X and Y, and the other with asset X and Z. And we find the portfolio returns based on the percentage contribution of each asset in their portfolio. So let's move on to this graph. So what we notice is that if we start with a low return, low risk asset, and we gradually add the share of a high return, high risk asset. If they are positively correlated, or if they have strong positive correlation, the risk, the total return for the portfolio increases and the risk also keeps increasing. If they are negatively correlated, or if they have very strong negative correlation, we notice that as we keep adding the high risk, high return stock or the high risk, high return asset, the portfolio risk decreases while the return increases up to a certain point. After that, portfolio return increases, but risk also starts to increase. So there is a point where, for which we get the highest possible return, but the minimum possible risk. And this happens when when the assets in a portfolio are negatively correlated. Another aspect of diversification is international diversification. So far, we were looking at asset diversification. Now we are looking at international diversification, that is investing in assets in foreign markets. It is helpful because all markets are not moving in sync. Some rise when others fall. So it also provides diversification opportunity to reduce risk of the overall portfolio. So what are the methods of international diversification? One is direct investment abroad. The investor invests in the foreign country. So there are risks involved, foreign currency risk. It becomes more, transaction costs are more, and so on. The other is to invest in stock or bond of foreign companies listed on US exchange. So one is Yankee bonds. So a foreign company issues bonds in the US market, which US investors can buy. So that is a way of international diversification. The other is American depository shares. Shares of foreign companies are traded on US markets against the actual shares held in their country of origin. The other is international mutual fund. So a mutual fund is a professional investment management company, and they may invest in foreign assets. So investors can buy schemes of such mutual funds. So another way to do it is US multinational companies, investing in US multinational companies. So because they have a portfolio of businesses in different countries. So they also provide international diversification in an indirect way. But the problem is that most of their revenues may come from the US. So this is not a very proper international diversification. So what is the thumb rule that advisors mention about international diversification? So they say that 20 to 30% of our investment portfolio should be in foreign investments, of which 2/3 should be allocated for developed foreign markets and the rest 1/3 in emerging markets. And one thing that we should keep in mind is the transaction cost of buying or selling securities in foreign markets is very high. That is for this lecture, and I'll continue with the rest of chapter 5 in the next lecture. Thank you.